Hey guys, hey, it's Chris with Life 180. Sorry, I had some technical issues hopping on the live. I ended up getting a phone call from a business partner in another business altogether, and this was going to be a last minute thing that I decided to do just because I woke up this morning. I had a lot of questions that have been coming through in a lot of the videos that I've been doing about Index Universal Life, about whole life insurance, about how to save. Is the life insurance policy an investment? What are the different moving parts in it? So on and so forth. I've been getting a lot of kind of angry comments. It's kind of funny to me. So I'm apologetic for the fact that it took me probably 40 minutes extra past the scheduled time for this to make this happen. But hopefully, if anybody's here now or you're able to watch the replay of this, that you will be able to benefit from it. So first things first, I'm looking down at my screen here. I'm noticing a comment from Jose. What causes the IUL cash value cap to decrease or increase? In what events do we see the cap significantly decreasing or increasing? So this is actually, so thanks for that, Jose, because that is, just hopping right into this, that is one of the most important elements of Index Universal Life that I really just don't like Index Universal Life because of this one thing alone. There's a lot of improvements that have been made over the years in Index Universal Life policies as far as the internal costs, as far as the administration fees, the insurance charges, so on and so forth. Now, here's the thing to think about though. The reason when you compare whole life to Index Universal Life and you think about illustration rates and expectations, I'm a big believer that you have to be able to have an expectation for like what your strategy is going to accomplish for you. And if it doesn't accomplish anywhere close to what you're expecting, then you're going to have a hard time executing properly, right? And that's my biggest challenge with Index Universal Life is that they don't build any ability inside of the illustration software to account for any of the fees changing, any of the cap rates changing, anything of that nature. And so that's one of the reasons I always tell people, if you can run an IUL illustration rate at about the 5% range, and be comfortable with it, be happy with it, then I say go for it. You're okay. But if you do that, what I'll say is like a whole life insurance policy is going to be just as good, right? Like it just is what it is. So to answer your question really directly though, there's nothing that ultimately causes an Index Universal Life. There's nothing in there that says they can increase or decrease. Here's how it goes. Index Universal Life policies, when I first started in the business, I was at National Life Group, and I actually was talking to the guy who designed the Flex Life policy there. Flex Life is the name of one of the Index Universal Life policies that National Life Group had back in the day, life insurance of the Southwest, all that stuff. So I was talking to the guy who designed the policy, and one of the things that he said was, when I asked him, I'm like, well, why are we doing this? Because National Life historically had always been a whole life company. They were a mutually held whole life company, pivoting, going the Index Universal Life route. And when I asked him, like, why are you doing this? He said, well, listen to this. So if you look at the long-term corporate bond rate, right, and you look at the fixed markets, well, insurance companies invest for longer periods of time. So they had 30-year bonds that were paying 20% at that time, like from 1981, and this was 2011 or 2012 when I was having this conversation. So if you think about that, 1981, 82, 83, 84, 85, 86, 87, those are all up until probably 1990, where there were 30-year time horizons, right? 1990 to 2020, that's a 30-year time horizon. You could get good bond rates, 30-year bonds that were paying upwards 8, 10, even up to 20% for a 30-year treasury bond if you got it in 1981 or so, right? So like, if you think about that, what happened is those matured, and when those guaranteed huge rates that were helping companies hold their dividends up, when those mature, what happens is it puts financial pressure on the insurance company to generate returns. Now, the thing is a life insurance company has to generate returns inside of their portfolio, inside of their general account for their policyholders. And so they have guarantees on the books across the board, whether it's inside of annuities and cash flow and guaranteed income, whether it's inside whole life policies guaranteeing a dividend, whether it's making sure they can meet their reserve requirements for the regulators and whatever the reserve requirements are for their accounts. Because remember, one of the other reasons I love whole life insurance as a banking alternative is because they don't use the fractional reserve banking system. So when you don't use the fractional reserve banking system, that means your money is in there. Like, you're going to always have access to it. Life insurance companies are not leveraged. That's one of the reasons that life insurance companies have never missed a dividend. They don't take on the risk that big banks take. Like in 2008 and 9, when hundreds and hundreds of banks went out of business because they were over leveraged and all that. In the Great Depression, when things went really bad because people were over leveraged and overextended, whole life insurance companies, for the most part, literally, I think in the Great Depression there was one company, I can't remember the name of it, that really struggled, that fell apart, a mutually held whole life insurance company. But for the most part, whole life companies are in a position where they are not overly leveraged. They're not going to be overextended, and so they're going to be in a position to make sure that your money's there, and so on and so forth. Now, when it comes back, sorry, this is my long answer to get to how do they adjust the cap rates. It all comes down to profitability for the company. It all comes down to the fact that if the company, the insurance company, needs to create revenue. The guy that designed the policy for Index Universal Life for National Life Group back in the day that I was talking to, he basically said this, is that the reason whole life companies are pivoting and starting to create Index Universal Life, I mean, even Penn Mutual does it now, which is crazy because they've forever been an amazing whole life company. They even have an Index Universal Life policy at this point in time. And so when you look at these Index Universal Life policies, they were created by these companies because the company, the insurance company, knows that they are offsetting the risk from the insurance company onto the insured. And Index Universal Life is great because it looks so sexy on paper. It looks amazing. Like, you can illustrate just amazing returns, and they look phenomenal. But the problem is, in the contract, you can see on an annual basis, the company has the ability to change fees, change insurance charges, change admin fees, and to change the cap rate. And so it is completely at their whim. So whether they do it or not, it's just up to the insurance company's judgment as to, do they need to create more revenue for the company or not. So think about it this way. And I used an example in one of my other videos. I'll use it again. I had a client that I wrote a policy for in 2011. It was a 14.5% cap rate in that policy. When I ran the illustration, I did an option B, min death benefit, max cash value. This thing was gonna scream. It looked amazing. 14.5% cap rate, 0% floor. All these things were awesome. But guess what? Over the past decade, the cap rate has dropped from 14.5% to 9.5%, right? So that's like a 38%. I think I ran the numbers on that, or something high 30% reduction in cap rate. The compounding effect over that, now that didn't happen overnight. It went from 14.5 to 14 to 13.5. They drop it by like 0.5% a pop. But over a decade, the compounding of that is horrible. Now, here's the other thing. When you run an illustration for somebody for Index Universal Life, you can't illustrate a potential future reduction in cap rates. The only way you can illustrate a reduction in cap rates is just to assume that it's going to happen. The only way you can do that is to run it at a lower assumed interest rate to accommodate for that. So you have to just kind of run numbers on the side to see what makes sense for you, and not buy into the fact that it's going to be stuck at the whatever the current rate is. If it's 13 now, just assume that it's not going to be there later, right? They use that. It's almost like clickbait, right? They use the high cap rate as a way to get you in and committed to the policy, and then they lower it over time. So here's what I would say to you. If you're somebody who believes, and this is just, everybody has to understand that we all have different risk tolerances, and what is right for you may not be right for me. Hey, what's up, Jose? So my meeting with Curtis is going to be happening in about an hour and 45 minutes. I'm doing this meeting, I'm doing this live, and then I'm going to go meet him for lunch. So thank you, Jose, for that. So I'm going to go do that today. But I'm on the West Coast. We're on the West Coast right now, so it's Pacific time, so not quite lunchtime yet. So everybody has a different risk tolerance, right? So think about it this way. When you look at the world around us, you can say, I want to go whole life route, or I can go Index Universal Life route. Both of them, the crazy part is both of them have the same philosophies, right? Both of them will as far as the people that are attracted to them, they want the tax-free growth. They want to, kind of have that rich man Roth mentality. There's a lot of leverage in the policies, and people who like these typically are people that distrust the government, are typically people that want to have control, liquidity use, and control their money. They want to be able to leverage it in very unique ways, right? And so here's the thing. If you believe that the government spending is going to keep going out of control, if you believe that that interest rates are going to stay low, if you believe there's going to remain stress on fixed income markets, which I believe all that to be true, then what's going to happen is that puts stress on life insurance companies to be able to perform and meet the guarantees that they've been selling over the past 30, 40 years, right? So what are they going to do? They have to create profit. If they can't get it from the returns in their general account, they have to create profit. So what did they do? They shifted. They're not stupid. They saw this coming 20 years ago. And they have since created these products that have given them flexibility instead of having just these pure guarantees, right? And that the other thing I'll say to this is there's a lot of talk going on right now about guarantees inside of whole life insurance contracts going from 4%. Like if you look at most of the significant mutual life insurance companies that sell whole life insurance, the guarantees in those policies are 4% right now. For so that's awesome. There's a lot of talk right now that going down to 3.5 or 3 or even 2.5% in certain situations. So like if you think about that, like once you get locked in, the people that have the 4% rate in a whole life policy, they're locked in. That is locked in, solid gold. Like that can never be changed. It's a contractual obligation by the insurance company. With an IUL, if we remain in a low interest rate environment and all this stress going on in the economy the way that we're talking about here on the fixed income markets, that what they're going to do to capture more money is they're going to reduce the cap rates and be able to keep more of that money to meet their reserve requirements, to meet the obligations that they have with the guaranteed contracts that they've already sold. Let me see here. When I brought this up, the MPI agent told me the insurance company is reputable and must be competitive with other insurance companies. Thus, it's unrealistic but possible it will happen. So that's absolutely not true at all. If you look at insurance companies over the last decade, think about it this way. I could list off some of the best companies that have index universal life that have been doing this for the last decade, right? Here's the thing, it has nothing to do with the market. This is the disgusting part and the reason that I started to dislike IUL. Because remember, I've sold more index universal life in my life than I should be proud to admit, like more than most people will ever sell in their life, because I was a huge index universal life person for a long time. What happened for me was I started to realize like, whoa, these cap rates are starting to drop. Oh, my policies are not performing the way that I illustrated them, even though I, as an agent, did everything the way that I felt needed to be done to protect, and I was sold on the value of an index universal life. I'm still not sure. Oh yeah, exactly. So even though I sold what I thought was the best policy and I designed and I drank the Kool-Aid and all that stuff, when I started seeing cap rates start to lower, remember this is in 2012, 13, 14, 15, and as that started to happen and cap rates, even in some of the best performing markets, right now we're in the greatest boom, the greatest bull market that the stock market's seen in over 100 years, right? So think about that. When companies are reducing cap rates during the greatest market, what are they doing? They're recapturing revenue, right? Because if the market is performing, that the insurance company's keeping the money that would have otherwise been credited to your IUL. Why are they doing that? They're doing that because a 10-year treasury note right now is paying under 1.5%, I think. I don't even know, I'm not sure, that may be a little off, but regardless, it's really disgusting how low a 10-year treasury note or a 30-year bond is paying right now. It's laughable. And so the insurance companies have no ability to get returns elsewhere. And so even though the stock market's looking really good, the big misnomer inside of IULs is you're not actually participating in the market. They're using different option trading strategies and arbitrage to be able to create returns inside of the index universal life policies for you. And they usually do it to the S&P or the Russell 2000 or the Dow Jones. It's one of those three typically that they do it with. And so you're not really participating in the market. They're just using options to be able to create those returns for you. Okay, sorry, I'm trying to check comments and read all at the same time. So like you're not participating in the market. What you have to understand is your money is never really in the market when you're in an IUL. They're just using these other strategies, which are fine. Like, don't get me wrong, But the bottom line is when they have the ability to just keep reducing and keeping more and more of your money, then that's where I have a big problem with it. And that's what was happening to my clients. And that's where I pivoted and I said, listen, like if that's the case, I'm a big believer that life insurance at this point in time, and I wasn't at the time, but now what I've learned is I'm a big believer life insurance should just be a savings alternative. It is a safe, amazing storage vehicle. It's like a bank account on steroids if you want to be able to access your money. I actually did a video on how to use whole life insurance as an investment, right? And it was all about investing in real estate because listen, I take more risk on in my life than most people are probably comfortable with. What I would say is that life insurance is not where you want to be taking your risk, right? Life insurance, the beautiful thing when you do it the proper way is that it's a guaranteed place that is not using fractional reserve banking. You have access to your money. It is the quintessential and asset. You can put your money in it, have access to it, leverage the guarantees in your policy, borrow against it, get something like real estate property that will appreciate. You can use the tax depreciation inside of the real estate. I actually did this video that showed how by buying one piece of property effectively, you could increase your wealth by over $300,000 just through the way you finance it. My problem with IULs is people sell the IUL as this tax-free income haven and rich man Roth alternative kind of thing. And the reality is when they don't perform the way that you think they're going to, what happens is if you make improper expectations and you're putting, let's say $10,000 a year into a policy or something of that nature, whatever, we'll just keep the numbers round, 10,000 into a policy, and you do that for 25 years, and then at the end of that time horizon, you want to trigger income. If you built that assumption at 6.4% or 6.5% or something like that, but they've reduced your cap rates, they've increased your fees, when they reduce your cap rates and that money isn't in your policy, what happens is the compounding works the other way, right? Because the way that the IULs compound so great in the illustrations is when you jam money in there, those fees get really negligible, like they're eaten up, they're covered by the internal growth. So that makes your policies more efficient on the illustration, which is great. Like, right, if it functioned that way, it would be awesome. Like, don't get me wrong. If I could buy an IUL policy and it would function the way that it would illustrate, I'd be all over it, but it just never does. And so the thing is that what you need to do is you need to take a look and say, okay, how would this function at a lower performance? I'm a big believer in under promising and over delivering. Like, I never want to put my clients in a situation where I'm not like able, where they're going to look at me, I guess is how I should say it, where they're going to look at me down the road and be like, whoa, Chris, like why is this not happening, right? Like, because I deal with real estate investors, I deal with entrepreneurs, I deal with people who understand their greatest investment, their greatest asset is themselves, their business, their unique set of experience and expertise. That's where they're going to get their returns. And even if IUL was great, even if it did perform even close to what they would say, I would still argue that it's not going to get, if you can't get an 8% return on your business, on real estate, on something of that nature, then you shouldn't be doing that in general. And if you can, I would say that why have a storage vehicle with a bunch of different sets of variables that you can't control when that's not where you want to be taking your risk. That's why I love whole life insurance. So IUL cap guarantee minimum is, yeah. Well, right, so the IUL cap guarantee minimum, think about that, is 3%. So the insurance company is saying, listen, even if we're giving you 14% now, we have the contractual leniency, the contractual ability to be able to reduce your cap rate from 14% to 3%. So when you look at a guarantee, this is my biggest problem with IUL agents, is they sell based on the current assumption, right? Based on the illustrated level. A lot of companies will have now a middle level, like a more realistic set of expectations because there were so many lawsuits with IUL companies. So a lot of them have like a middle set of expectations, right? And so that middle set is like baked into the policy by saying, hey, listen, you may have this here, this current illustration level, but this is kind of like what you should expect. And I know for a fact that those are there because that's more close to how they've performed. And that is the legal, that is like a legal response to all the lawsuits that have happened and these things being sold so improperly, right? Now the guaranteed column, do I think the guaranteed column will ever come to be in an IUL policy? The answer is no. Like, if I'm going to be totally real, the answer is no. I don't think it will ever be that bad. However, I don't think it's necessarily going to be that far off from it either, because it does, it takes into consideration the worst case scenario for everything. The answer is, I think it's going to be somewhere in the middle. If you're looking at an illustration that doesn't have a middle column that's automatically generated by the insurance software, by the company that you're looking to buy with, then you have to take that. You have to figure out and use your own judgment. What I would say, if I were a consumer looking to buy an IUL, and I've thought about it, like getting another IUL, whatever. But if I were looking to do this, I would not buy it unless I had a guarantee, or not a guarantee, but unless the numbers worked out and I was 100% comfortable with them at 5%. That's it. Like at 5%, that's what I'd be comfortable with. And the reason why is because, listen, like, I think that's just more in alignment when you look at the economy, when you look at the markets, when you look at the fixed markets. Unless you believe, like, this just comes down to your set of beliefs. I have framed my opinion on why I like whole life insurance so much simply because of the markets, because of the environment that we live in, the economy, the government, everything that comes into it. I have no doubt that right now that the interest rates are going to stay low. The federal funds rate is going to remain low. Why? Because it has nothing to do with your whole life policy or your index universal life policy. But it puts a huge amount of stress on savers, on people who are going into retirement that are looking to, gain guaranteed income from the fixed income markets. If you're a life insurance agent, by the way, annuities right now are an amazing, amazing, amazing tool for people entering retirement, simply because of the fact that it is retirement income insurance. What we're going to see is insurance companies are going to start filling more of these needs, but they're pivoting where they're going to like give these guarantees to for people. Whole life insurance dividend guarantees are going to come down. I guarantee it. Like, it's going to happen. Some companies are going through that process right now. So your ability, if you can get in and lock in a 4% guarantee now, I would do it all day long. But on the index universal life side here, if you believe that the government is, not going to continue to print trillions of dollars, okay? If you believe that interest rates, the federal funds rate, is going to go up and is going to increase, which is going to allow the bond markets to increase the guaranteed returns when you buy bonds, then okay, that's great. But here's the problem: if that happens, that creates a bond crisis with all the bonds that have been out there, right? Like, we're kind of in this situation where we're damned if we do, damned if we don't, right? And that's one of the reasons these insurance companies are going to have to recapture revenue. There's no way around it. Life insurance companies always deal in the world of guaranteed in fixed markets. They always have, they always will. That's the only way it works. And when you look at how much stress is on the fixed market right now, that's one of the problems right now. And that's why I believe index universal life policies are going to struggle, because always look at what's the minimum cap rate that an insurance company can go to. Not that I think it will always come to that, but look at what the minimum cap rate is. Look where it is now. Realize they can drop it, and realize that they're going to drop it. And assume a smaller return, because when they drop that cap rate either 1 or 2 or 3%, it's going to drop the assumption rate for how that policy is going to perform pretty significantly. So I hope that makes sense. All right, so I am looking up some comments here. So here's the deal for me. Let's see here. Like I said, I'm running a little late. I didn't have as much time as I wanted to on this. Ultimately, I'm going to show you what I wanted to do. What I wanted to do was kind of go through here. I'm going to show you here really quick. I wanted to show you some of the comments. Like, these are comments. This is, if you've ever looked at, if you've ever been a creator on YouTube, you get your back studio and you get a comment section. When anybody wonders how I respond to all the comments, I just come in here every day and I look through my comments. And what I wanted to do was go through and engage with here, but because I apologize because of the fact that I was late getting on here and things were happening, what I will do is later, once I get done my lunch, I'm going to come back And I'm going to do another live this afternoon, and I'm going to get into this live because there were some really good comments in here, and there was some good feedback, some people that were pushing me pretty hard, that had great questions, great comments, some people that were defending Index Universal Life in a way that I think is unethical. But it's hard to respond in a comment and be effective to really explain it all out. So what I want to do is I want to, like this guy, Marietta Velo, or this woman, Marietta Velo, she was one of the ones that was just way off base. It was craziness. And there's D-Moon, this guy, he was kind of crazy too. He got a little insane and upset at me. Victor Cuevas, this guy. Yep, so these three people specifically, I want to go through their comments, and if anybody has any other comments that they saw that they want to point out, you can feel free to copy and paste them into the chat live when I go later. And I figured I'm getting so much engagement, so many comments about all this stuff, it would be good to just get on here, set the record straight, because I truly, if you're not familiar, or if you haven't picked it up yet, I'm not licensed anymore. I gave up my licenses back in 2016, so whatever that is, 5 years ago. And so I literally just run a business development company where I work with entrepreneurs, where I work with real estate investors, and where I work with life insurance agents to help build their business online, right? Like that's what I do. I'm a certified ClickFunnels expert. I've worked personally with Dana Derricks, who's the best-selling author of The Truth About Business and the Dream 100 strategy, and I run a Dream 100 agency, and like I love the business development side of things, but I'm just super passionate about leveraging life insurance as an asset to accomplish what you want to accomplish in your financial life. I believe the system that you use with your finances in your business are essential to your success. So I'm really looking forward. I'm going to switch back over here. I'm really looking forward to doing this. I think these sessions are going to be a lot of fun for me, selfishly, because I mean, I'm just really passionate about this. I hope they serve everybody the way that I think they're going to. I really, honestly, they're going to be as good as people kind of bring to the table as far as the questions that you bring to them. And like I said, I'll go through my questions, comments that I get from people throughout the week, and hopefully it will serve people. So anyway, I'm going to get ready for my lunch to go meet Curtis Ray. It's going to be a lot of fun. I genuinely am hoping to be surprised by this. And like, I like the guy. I had a conversation with him the other day. He seemed like a nice enough guy. My hope is that he just doesn't realize what he doesn't realize. I know I've been unlicensed almost as long as he's been licensed, right? I've been around the industry a long time. And so, we'll see what happens. He seemed like a nice enough guy. I don't want to be throwing mud at people, when it's not necessary. So hopefully we can come to some sort of agreement on how all this works, and we'll go from there. But you guys, thank you for being here. Once again, I apologize for being late. I won't be late again, or I'll be a little more careful about how I schedule my lives. So anyway, I'm just getting used to the whole live thing and doing this. So anyway, hope you have an awesome, inspirational, blessed day, and hopefully I'll be back on later this afternoon, and we'll see you there. See you guys.